Zurich, 2023. You step into a discreet bullion bank office a few blocks from Bahnhofstrasse, where wealth is preserved quietly and rarely questioned. Glass walls, muted light, the quiet confidence of institutional money. On your statement sits a single line: 50 ounces of gold. At roughly $2,000 per ounce, it's worth about $100,000. Today, you want the metal. You ask for delivery. Not sell it, not trade it, withdraw it. The banker checks your account and introduces a detail most clients never encounter. Your position is held in an unallocated gold account. The ounces on your statement are not specific bars stored under your name. They are a claim on the bank's pooled inventory. The metal exists, but it isn't assigned. Under normal conditions, the distinction stays invisible. Most investors never request the bars. The system works because claims circulate while the metal stays largely still. But once you notice the structure, the layers become harder to ignore. Your statement shows gold. The vault holds pooled metal. Global markets move far more ounces than physically leave a vault. 1 ounce. Multiple claims. The system works, as long as movement stays small. So a quieter question begins to form. What happens when many owners decide they want the same metal at the same time? What you encountered in that Zurich office isn't a technical footnote. It's the architecture of the gold market. Today, a single ounce of gold can sit behind 3 very different promises. And once you see those layers, the system stops looking like a simple vault. The first promise is allocated ownership. Specific bars stored in a vault under your name. The second is unallocated gold. A balance on a bullion bank's books, where your ounces exist as a claim on pooled metal. The third is financial exposure. Futures, ETFs, and derivatives that track gold's price without requiring the metal itself. All 3 reference the same asset, but they behave differently. One is property. One is a balance sheet obligation. One is a financial contract, ownership, exposure, metal versus ledger. Most of the time, the difference stays invisible, until conditions tighten. Because when pressure appears, these layers don't move together, and the first layer, the one closest to the metal, is not as simple as it looks. Start with the first promise, the one that seems simplest: allocated gold. This is the structure most people imagine when they think about owning the metal. A specific bar, a specific weight, a specific serial number, stored inside a professional vault. In an allocated account, the gold is not part of the bank's balance sheet. The institution stores the metal, but it does not own it. Legally, the bar belongs to the client. The vault operator acts as custodian, not counterparty. If the institution fails, the metal does not become part of its assets. It remains yours. This is why allocated gold is often described as the closest form of financial ownership to physical metal without holding the bars yourself. And the infrastructure behind it is global. Major vaulting centers in London, Zurich, and New York store thousands of tons of gold on behalf of central banks, funds, and private investors. Most of these bars follow a standardized format known as London Good Delivery, roughly 400 troy ounces per bar, weighing about 12 kilograms. In this structure, the relationship is straightforward. Metal exists, ownership is clear, claims do not multiply. But even here, the simplicity has limits. Because once gold enters a financial system, even under allocated custody, it begins to interact with institutions, clearing networks, and market infrastructure. And that is where the clean line between metal and market slowly starts to blur. Now, step 1 layer deeper into the system. This is the structure you encountered in Zurich: unallocated gold. At first glance, nothing seems different. Your statement still shows ounces. The price still moves with the global market. Your balance rises and falls with every tick in the gold chart. But legally, the structure has shifted. You no longer own a specific bar, you hold a claim. Inside an unallocated account, the metal sits within a pooled inventory controlled by the bullion bank. Client balances are measured in ounces, but those ounces are not attached to individual bars. They exist on a balance sheet, which means the relationship changes. Allocated gold is custody. Unallocated gold is counterparty. The bank now owes you gold, but the metal itself remains inside a shared pool used to support trading, settlement, and liquidity across the bullion market. There is a reason the system is built this way. Gold markets move continuously across London, Zurich, New York, and Asia. Banks need flexibility to clear trades quickly and supply liquidity between participants, and most of the time, the structure works. Balances update, trades settle, claims circulate, because most account holders never ask for the bars. The claims move quickly, the metal moves slowly, and the system stays balanced as long as that behavior holds. But the further gold moves from custody toward balance sheet, the more the market begins to rely on something less visible. Confidence, because the next layer of the gold market moves even further from metal, and there, the ounces often exist only as price exposure. Now move to the third layer. Here, the distance from the metal becomes wider. This is financial gold, futures contracts, exchange-traded funds, options, and derivatives. These instruments allow investors to participate in gold's price without interacting with the metal itself. Take futures markets. A single contract can represent a large quantity of gold, allowing traders to gain exposure instantly. Positions open and close continuously throughout the day. But the critical detail sits beneath the surface. Most of these positions never settle in physical metal. They close financially, positions roll forward, balances clear in cash. The exposure changes hands. The bars rarely move, and that difference changes the scale of the market. Because once gold becomes price exposure, trading can expand far beyond the pace at which metal physically leaves a vault. Inventory moves slowly. Liquidity moves constantly. Vaults store the metal. Clearinghouses circulate the claims. At times, the number of ounces referenced in financial contracts can grow far larger than the amount of gold likely to move through physical delivery channels, not because the metal multiplies, but because claims can multiply. And when you step back, the architecture becomes visible. A scarce metal at the base, layers of financial promises built above it. Metal, balance sheet, contract, 3 layers, 1 ounce, and this is where the realization begins to shift. Most participants in the gold market are not actually trading gold. They are trading exposure to gold, price exposure. Once you separate the layers, the system becomes easier to see. Physical bars stored in vaults, bank liabilities recorded in ounces, financial contracts referencing the price. 3 structures, all pointing to the same metal, but they behave differently. Metal moves slowly. Balance sheets adjust faster. Financial contracts move instantly. The gold itself does not multiply, but the claims on gold can. And that distinction quietly reshapes the scale of the market. Because the modern gold system allows a single underlying asset to support multiple layers of ownership, obligation, and exposure. 1 ounce of metal, several promises attached to it. And once those promises circulate through banks, exchanges, and clearinghouses, the gold market begins to look less like a vault, and more like a financial architecture built on top of a scarce foundation. And this is where the arithmetic begins to matter. Gold supply moves slowly. Each year, global mining adds only a small increment to the existing stock of metal. New bars enter vaults gradually, measured in tons, not in sudden waves. The physical base grows at a deliberate pace, but the financial system surrounding that metal moves very differently. Futures positions open and close within seconds. ETF shares expand and contract with investor demand. Balances inside bullion banks shift across accounts and institutions. Exposure can move continuously. Metal cannot. And that difference creates a quiet structural clock inside the gold market. Not a countdown, not a prediction, a constraint. Physical gold accumulates slowly. Financial claims circulate constantly. The two speeds rarely collide because the system depends on behavior. Most participants trade exposure. Very few request delivery. But the architecture works only as long as those roles remain stable. Because when a slow-moving asset sits beneath a fast-moving financial layer, the entire structure begins to depend on something invisible: time, and how long the balance between metal and claims can hold. Step away from the institutional language for a moment. Picture three investors. One of them might be you. The first stores allocated gold in a vault, a specific bar, a recorded serial number. The metal exists independently of any bank balance sheet. The second holds unallocated ounces at a bullion bank. The statement still shows gold, but legally the position is a claim on pooled inventory managed by the institution. The third holds gold exposure through a financial instrument, an ETF share, a futures position, a contract that mirrors the price of gold without touching the metal itself. From a distance, they look identical. All three watch the same chart. All three see the same price. But beneath that price, the structures are different. One depends on custody. One depends on a counterparty. One depends on a clearing system. Most of the time, the distinction stays invisible until the system is tested, because when pressure appears, ownership, obligation, and exposure rarely move in perfect alignment. And that leaves a quieter question. Not about gold, about which layer you're actually standing on. Widen the frame for a moment. Gold is not the only market built this way. Modern financial systems regularly transform scarce assets into layers of tradable claims. Government bonds circulate through repos and collateral chains. Currency reserves move through balance sheets far faster than physical cash ever could. Commodity markets allow exposure to oil, copper, or wheat without barrels, warehouses, or ships' ever-changing hands. Liquidity grows through financial layering, not through physical expansion. Gold simply makes the architecture easier to see: a fixed metal base, multiple financial structures referencing it. Most of the time, those layers function smoothly because participants interact with price exposure, not the underlying asset. But the system quietly depends on a simple behavioral pattern. Claims circulate. Metal stays still. And when the balance between those two speeds begins to change, which layer moves first? Gold itself has not changed. A bar still weighs what it weighs. An ounce is still an ounce. What changed is the system built around it. Modern markets separated the metal from the promises attached to it. The metal sits in vaults. The balance sheets record claims. The contracts circulate exposure. 3 layers, all referencing the same scarce foundation. Most of the time, the system works because each layer serves a different purpose: storage, liquidity, price discovery. But once you understand the architecture, the gold market stops looking like a simple store of value. It begins to look like a financial structure balanced on top of a fixed physical base. 1 ounce of gold, multiple promises. And in every financial system built this way, the arithmetic always sits underneath. Step back to that office in Zurich. The number on the statement has not changed. 50 ounces of gold. The price still moves with the market. The balance still looks the same. But now the structure behind that number is visible. 1 layer stores the metal. 1 layer records the claims. 1 layer trades the price. Most of the time, those layers move together closely enough that the difference feels irrelevant, until someone asks a simple question: can I have the bars? And that question quietly reveals the architecture underneath the market. Because once you understand the layers, gold stops looking like a single asset. It becomes a system of promises built around one scarce metal. If this structure surprised you, comment: 1 ounce, 3 promises, and the next time you see gold on a balance sheet, you'll know to ask which layer you're looking at.